Andrew Holland joins in to talk about that. Andrew, good morning. First, a quick question on whether for the institutional community all the tax questions have been allayed, or do you sense that there's still some lingering nervousness around that may be impeding flows in the near term?
Yeah, I think there's always going to be lingering concerns now. It didn't go away, it hasn't gone away. And I think, as we move towards, it's a few years in terms of 2016, but I just think that FIIs will be a little bit worried and will continue to try and think about how they're going to, remove these fears from their own funds going forward. So I don't think the issue's gone away. I mean, we try and look at it if it's gone away, but I don't think it has.
Is there as much nervousness about the currency as well, Andrew? We're hearing more and more about how people foresee more depreciation for the rupee, and that's becoming a source of worry again.
Yeah, well, when you listen to the finance minister in his budget speech, at the very beginning he said there's two things that he wanted to kind of put emphasis on. One was growth, which we didn't hear very much about. Growth in the economy, that is, and the current account deficit was his main concern, of which he never really tackled. So I think the current account deficit is going to be the driver really for the currency. And again, I think the figures there are not going to look so good. We're hearing near 6% of GDP, and I think that will keep markets a little bit spooked about what the government can do there.
Andrew, what we did have this morning was a much stronger global context, both in terms of what China was saying about growth and the US markets themselves. Do you think some of that rough patch in terms of global markets is behind us, or is it still an extremely volatile situation?
I think, perhaps we got on Thursday, I think there'll be extra interest paid towards what the European Union and the UK Bank of England do in terms of their interest rates, and expectations are that there could be some more easing there, so that might keep the rally going. But I'm still not overly convinced on this great rotation trade. I think there is a move from bonds to equities, but really where you're getting higher dividend payouts by US companies. And I think that's skewing the figures and skewing the view that everyone's rushing back to buy equities. So I don't think that's the case yet, although inflows have been very strong into US equities in January. So there's some outstanding kind of issues out there, Italy being one. Will they have more elections or not? So these things can come back to haunt us a little bit. So for our markets, it's great that we've had a global rally, because I think otherwise we would have headed towards 5,500 and Nifty, and I think that could be a realistic target in the very short term, because unless the rally holds, then our expectations are going to be shot again, and there's nothing really that the finance minister did in the budget which kind of makes me feel the momentum is there for either the economy or for markets to move higher. India has been one of the worst performing markets so far this year, and I think that will continue to be the case in the very short term. So here's what I think. If global rallies continue because of the liquidity into next week, then we're all going to get excited about what the RBI could do, and we could see a little bit more move higher. But if that's not the case, then I think our markets retreat. Yesterday was a great rally, but it was probably more short covering. I don't see it in the FII figures, and obviously we had the domestic institutions selling more than the FIIs bought. So I don't think this momentum is going to carry myself, and I think we're more likely to go down than we are up in the next few weeks.
Andrew, hi, good morning. In that context, we have not seen too much money getting pumped into India dedicated funds in the last many months. In fact, whatever has come into global emerging market funds. Do you think even within the Asian gamut, India will lose its focus because of the macro concerns that you alluded to?
Yeah, I think so. I mean, there's been a lot more interest towards China. I mean, apart from that blip on the few days ago when they talked about taxing on property, I mean, obviously the new leadership is talking growth, and will continue to do so. So I think, given the valuations in China, I think that's standing out more. Brazil and Russia still look more expensive than India, so you could get more incremental flows, but I think those flows to India are going to be easily gobbled up by a lot of the issuance, both by governments and by the corporates in India. So I don't necessarily feel that the market's got the momentum to move higher in the very short term. So if there's any negative news or any sell-off in global markets, I think that will increase the pressure on India. And I think, after putting $32 billion into India and seeing the currency continue to weaken, has got to be worrying for global investors. And it only makes me feel, if you go back say a month or so ago when you were looking at, say, sterling, of why it was weakening, the answer came with a rating downgrade. So I'm not saying that's going to happen to India, but there's something holding that currency and making it weaken, and it's not just about the current account deficit, I'm sure.
So sectorally, how do you prep yourself for any kind of impending downfall? You alluded to the 5,500 mark on the Nifty. If that is coming, perhaps, sectorally, which is the most vulnerable pocket in your mind?
Yeah, well, we haven't really kind of changed our strategy so drastically coming into the year. I mean, we kept with our defensives in IT, consumer goods, and pharma, and nibbled away at some of the interest rate sensitives, but very selectively. We'll probably continue to buy more of the interest rate sensitives, i.e. banks, real estate, a few selective capital goods companies, if the market continues to go down to that 5,500 level. So that's what we're really thinking at the moment. So no real change in our strategy. We were never a believer at the beginning of the year to jump into high beta, questionable management type companies with high debt.
On that point about India underperforming, Andrew, is it possible that that's the kind of year we're shaping up for, that we turn out to be an underperformer market, as also have the potential of losing some of our valuation ratings?
No, I don't think we're overvalued, don't get me wrong. I think the valuations are reasonably attractive. I just don't think there's anything from the macro perspective to get investors excited. I think we're all baking in 50 to 75 basis points cut by the Reserve Bank of India. So that really hasn't changed. So, we've always been saying that, we expect the market to move in line with earnings, and earnings we think will be around 14-15%. So that's the kind of rise we could expect this year from the markets. But I think it's going to be more back-ended. I'm getting that feeling it's going to be more back-ended than it's going to be front-ended, because there's a lot of headwinds there, and I don't think anyone's convinced that the numbers put forward by the finance minister are really stacking up. So what we need to see is more policy action, and obviously land acquisition would be one of them, to my mind. GST, if they can move that forward, would be another. But without those, I'm not really seeing what the momentum can be to get investors excited at the moment.